Subscribe to our YouTube channel and press the bell icon to never miss any update from Samco.
Hi everyone, I'm Sandeep Abange. After a slew of IPOs that hit the market in 2021, investors are still looking hungry for more. And this landmark IPO surely has the potential to satisfy that hunger, at least from a listing gains perspective. Yes, I'm talking about India's much awaited IPO of 2021. India's unicorn, ZOMATO Limited. Starting with the IPO details. Delhi-based ZOMATO Limited is planning to raise a whopping Rs. 9,375 crore via a fresh issue of Rs. 9,000 crore and an offer for sale of Rs. 375 crore. This IPO will remain open from 14th of July till 16th of July 2021, and the price band is fixed at an attractive price of Rs. 72 to Rs. 76 per share for a lot size of 195 shares per lot bid. As of FY21, it was present in 525 cities across India and 23 countries outside India with a close to 3,95,000 active restaurant listings. You should take a note that although it is present in 23 countries outside India, but it aims to focus only on Indian markets for now. Moving on, let's understand various growth opportunities for ZOMATO, for which we need to look at the overall Indian food services market. Out of the total food consumption, which is nearly a quarter of the Indian GDP, just 10% consists of food services in comparison to more than 50% spent in China and US. This shows how underpenetrated India's food services market is. Now, for ZOMATO, it is important that the share of organized food services market to rise over time to increase dine-in and food delivery salience on a structural basis. Apart from this, internet penetration has played a huge role in ZOMATO's growth over the years. From 2015 to 2020, India's internet and smartphone penetration has more than doubled. Thanks to a drastic decline in data rates, however, only 9% of internet users in India are currently ordering food online versus 36% in the US and more than 50% in China. Therefore, ZOMATO can experience a huge runaway for opportunities in this space, and digital ordering trend is only expected to grow going forward. Let us now look at its business model. ZOMATO aims to build an entire ecosystem around restaurants and food delivery systems by catering to every need of the customer. It is involved in both the B2C as well as the B2B space. More than 80% of its revenues comes from the B2C segment, which is its popular food delivery business catering to both the restaurants and delivery partners. In B2B, it caters to only restaurants and restaurants plus customers, where it offers restaurants to list on their platform in order to enhance their visibility in consideration of a small advertisement fee. And the other one, which is a fairly nascent business for ZOMATO, which is called Hyperpure. In Hyperpure, the ZOMATO mainly supplies key raw materials to produce, which are directly sourced from farmers. This helps restaurants to reduce their overall cost on the food making business. Now, ZOMATO has four major strengths. First, it is its comprehensive food delivery platform, which follows an end-to-end food service approach by combining the offerings of US-based Yelp, which is an online review platform, DoorDash, a food delivery platform, and OpenTable, which is a food reservation or table reservation platform. ZOMATO has all these features in a single mobile app. Secondly, it has a strong restaurant network of over 3.8 lakh restaurants across 525 cities in India. Thirdly, it has an efficient delivery network wherein its delivery partners successfully delivered approximately 94% of their total orders with a median delivery times of less than 30 minutes. Lastly, it has built a strong technology platform which leverages artificial intelligence and machine learning to collect and curate a structured content. So, this machine learning data is therefore stored in their particular platform. Zomato acquired 68% of their new customers via this platform organically in FY21 and not via any paid advertisement. As you can see, Zomato has witnessed a significant improvement in its unit economics. The company had better pricing power in FY21 while its cost remained under control. This helped it achieve positive unit economics for the year FY21. But there is a catch. The profit contribution has seen a decline as a percentage of gross order value over the recent quarters. This can be attributed to higher discounting and revival of competition as India saw active participation from peers in the later half of the quarter in FY21. On the operations front, the gross order value has witnessed strong growth over time, but it didn't escape the pandemic either. Despite that, the company managed to grow its gross order value at a CAGR of 32% over the past 3 years. Zomato also saw a rise in its average order value from Rs 282 to Rs 397 in FY21, which was critical for it to achieve positive contribution per order. Visitor metrics such as monthly active users and monthly transacting users have been on a consistent rise and only saw a dip in FY21 due to the lockdown. Despite this, the growth in these metrics is expected to continue going ahead as more people explore and order from Zomato. Moving on to financials. While revenues have scaled up sharply despite the impact from the pandemic, the profitability continues to remain in doldrums. Yet, despite the erratic profit flow, the company has been able to narrow down its losses over the past 3 years, as it continues to leverage its scale. Also, with the IPO, its cash balance is expected to shoot up to more than rupees 14,000 crore rupees, which is sufficient to last for the next 6 to 7 years based on the current cash burn rate. Coming to the risk part, Zomato faces intense competition from multiple aggregators who are actively engaged in the food delivery domain. While the unit economics became profitable in FY21, which was mainly driven by reduced discounts as well as higher order value in a pandemic year. As PS continues to expand, number of discounts can only rise from here, which can only dent margins from here on. Some restaurants are resorting to taking orders directly from customers instead of Zomato and other aggregators, which can further reduce Zomato's revenue going forward. National Restaurants Association of India has had a long dispute with the aggregators, due to which it has planned to launch its own app to take on the aggregators. Lastly, any future waves of COVID-19 and further lockdowns can impact the delivery business as mobility restrictions, restaurant shutdowns, and hygiene concerns can serve as severe headwinds for the company. To conclude, Zomato's valuation on price to earning is not possible as it is a loss-making company. But as per its price to sales, it looks attractively priced among its global peers. The pandemic has made food delivery platforms look more attractive because of acceleration in demand during this period. But whether this can sustain over the longer term or not still remains to be seen. But for now, we recommend investors to subscribe to this IPO for listing gains only. Thank you.